Good afternoon. My name is Peter Grandich. For the next 15 minutes, I shall be your speaker. Any readers of my blog here? Okay, thank you. I do three things. I publish a blog. I spent many years on Wall Street in various positions in money management, and in the last several years, I've been a consultant to public companies. My second business, for those that are from New Jersey, I reside down in Freehold, and I run an insurance and estate planning company, mostly for professional athletes. And my third line of work is I am in Christian sports ministry. I spent a good deal of time with the New York Giants and the New York Yankees. And to tell you that God has a sense of humor, I was a diehard Met and Jet fan. So there it goes. If I knew for certain or near certain where the markets are going, I'd be calling this in from one of my Caribbean islands. So there was a great man that used to speak here many years ago. It's been several years since I've spoken here. He passed away, but he was probably the most kindest, greatest newsletter writer I ever met. His name was Grandich, for those that may remember many years ago. And he had an old saying, and it's very true. He says, those of us who live by the crystal ball, over time learn to eat a lot of broken glass. So please don't treat this as gospel or investment advice. It's one man's opinion who's done this for almost 30 years. And maybe I'm a little past the blind squirrel, and I do find an extra nut or two versus some others. A quick comment on the markets before I focus on the topic of gold. In 2007, in late 2007, I issued only for the second time ever in my life for people to go short the U.S. stock market. In 2009, in March, I suggested we would have the greatest bear market rally we would ever see. And now I believe we operate under a secular bear market that eventually will take us to new lows in the U.S. stock market. I believe it's a mistake for investors, and this is not a general equities conference, but I do believe many North American investors are making mistakes by having a large part of their general equity portfolio not related to metals and mining in U.S.-based companies when the U.S. is no longer the economic engine that pulls the world around. If you're going to invest in general equities, and remember what the stock market's supposed to be, it's part ownership of companies, you need to invest where the growth is. And the growth is mainly outside of North America and mostly in Asia. So unless your general equity portfolio minus metals and mining is overweighted there, you are not invested in the area where we're growing. And quite frankly, if you miss China, my suggestion to you would be look at India. India will be the next China in the next 10 years. In terms of bonds, I only have one opinion. It will be, in my opinion, the worst investment in the next 10 years. I've sooner seen people loaded up in general equities or actually short gold, if you can imagine that, than be long bonds. Bonds, unlike stocks, don't have the opportunity to have something great happen, and individually they could go up many times more than what you paid for it. Bonds are either going to pay off back your principal over time, or may be bumped up in a little in value if interest rates drop. The problem is interest rates really can't drop that much more. The other difficulty is that I believe inflation is a lot higher than what our government tells us. So even if it's 3 or 4% and I'm getting paid 2% to hold paper for 10 years, it's a losing investment. So the last place I want to be is bonds. And my readers know that I've been looking for an opportunity to go short bonds. I have not done it. Some people got mad because they thought I should, but the yield is coming back to the area where I hope to get short, but that's something we'll look for in the future. The U.S. dollar is not a market that's rallying, but rather a euro that's going down, and there's a difference. We have the largest net long position in the futures market in the dollar in over 10 years, and the dollar can't even get over its first resistance level around 83, 84. If and when it does, I will change my view likelihood, but for now I think the dollar is going nowhere fast, and after our election is over, no matter who wins, the dollar will go lower. And the last market that I take a look at from now and then, other than the metals, is oil and natural gas. Oil is a buy on any weakness. Natural gas is a void. There's too much of it. There's too much new technology that will continue to get too much of it. And until such time, North America, at least in particular the U.S., truly switch over to true natural gas usage for all things that they can, natural gas prices can't go that high, in my opinion. Now let's talk about what probably a lot of people have come here to speak about, the gold market. I have coined it the mother of all bull markets. A little over $300 an ounce. In 2003, I went long, and I haven't looked back since. There have been occasions where I've suggested to my readers there were times to take profits, but I remained an ardent bull. I'm not a bull because I enjoy wearing tinfoil hats, loading up on ammo, buying cabins in West Virginia, and stocking up on dry food. That's a fallacy, because I can assure you if the world comes to the point where you'll need those things, it won't matter that you own the gold, because the people who survived whatever the calamity was to cause that will seek out those who do have the gold and take it from you. And your army will never be big enough, and you'll never have enough dry food or be too far in the forest for them not to find you. So I don't own it for disasters or hoping the world's coming to an end. I hold it because I believe it's an appropriate investment. But I am troubled that an investment over the last 10 years that outperformed just about everything else, those few true bulls who remain bullish always seem to have to defend it. And that's the position we're in again. So I'm going to defend it to you in what I think are the responsible, legitimate reasons why one should be bullish on gold. First, the reason most bears have missed it and continue to miss it is they didn't recognize and continue to refuse to recognize three dramatic changes in the gold market. The first was there were large, major sellers of gold constantly. They're called central banks. For years after years, they were major sellers. Anytime the price would rise a little bit, they sold some. Then the Washington Accord was created, and for the first time their sales were managed. And in the last 2 years, they haven't been able to even meet the quota they gave themselves in terms of sales. They are now net buyers. You will recall in the third quarter of last year, the bears, when they came out of their foxholes again and wiped off their blood, they told us how gold was going down for the umpteenth time and central banks were going to become sellers. Well, what do we learn? In the fourth and first quarter of this year, they've been net buyers. The second fundamental factor that changed was producers were no longer forward selling. They were literally no longer cutting their nose to spite their face. If you're a hedger now, try to speak to an institutional or retail investor. They'll sell your stock. So selling forward is a dying art. It's gone. I don't think it's coming back anytime soon. But the thing that took it over the top and changed this to a very bullish factor was the creation of ETFs. Now, ETFs did hurt the mining game. Now, I'll talk about that in a minute. But they helped dramatically the physical purchases of bullion. Because when I used to be a money manager, before ETFs were created, the only choices I had to have exposure to gold was either buy the encumbersome, costly, and painstaking part of holding physical bullion or buying major mining shares as a proxy. When the ETFs were created, I was able to get direct exposure to gold at an extremely low cost, and most important as an institutional investor, the ability to get liquidity even during the day versus an end-of-day price. Those factors still remain extremely bullish for gold. The other factor for gold, and why I believe it has risen, which isn't taken into account by most of the bears, is that gold isn't a currency. There's only 4 major pools of currency where real money can go to in the world: the US dollar, the euro, the yen, or gold. As much as I love the Canadian dollar and converted most of my own assets into Canadian dollars several years ago, it's not big enough for large sums of pool of money around the world to go to. Gold has become to some, but not yet to many, particularly in North America, an alternative to other paper currencies, and one of the reasons it's risen. Now, one key factor which is hard for people to accept, and because of what I noted again today on my blog, some people say I'm even being unchristian-like. But this is a fact of life that you have to deal with. Gold is hated, and I underline the word hated, by the financial world in general and most of the media that follows it. They rather make fun of it at the expense of other people who are bullish on it. But the fact remains you are never going to see universal acceptance for gold as an investment. Because if you think about it, if you're selling stocks and bonds as your livelihood, the only reasons gold should be going up is bad reasons for stocks and bonds. If I'm a car salesman, I'm not going to try to sell somebody a Schwinn bicycle. So I don't expect the financial world ever to rally around gold. What does irk me, and what led me again this morning to make yet another challenge, is that most in the financial media continue to give widespread coverage to bears who've been wrong all the way up. My readers know that we've been battling this since $300. If you can recall, when we couldn't get above 500, that was the end. When we couldn't get above the old nominal high of 850, that was the end. The 2 times we couldn't get through 1,000, that was the end. The first time we went to 12 and 1,300 and came back to 1,000, that was the end. Last September was the end. December was the end, and now, of course, and soon Mr. Gartner will be up here telling us why this is the end as well for gold again. Yet, from an investment standpoint, I don't see anything else in the last decade that's done better, yet we have to defend ourselves. Why? Well, part of that reason, I think, is, and my time is running out, but part of the reason is because we also dabble, and to some of us like myself, aggressively into mining stocks. And there the performance has been poor. And so it appears a lot worse than it looks. But the bottom line is there is no gold bubble. And the next time you hear somebody tell you about a gold bubble, say baloney, or if you're like me from the Bronx, use other words. But I'll use baloney here. Because to have a bubble, you need to have lots of people in that bubble. And I can assure you, if we went to anywhere in the United States and walked into any financial institution and looked at any 100 accounts, 99 and a half of them have no exposure to gold. So to call something a bubble, let's call it something else. Let's say you admit that you hate it and you don't want to own it. But let's not call it a bubble. Now, I think this is a contrarian's dream come true. Since last December, we've seen an absolute avalanche of new and old bears alike talking about gold peaking. Go Google it. You'll see for every bullish article of gold now, there's 10 bearish ones. Even some of the most ardent bulls have gone into hiding or tried to make themselves look like bears. We've had a massacre in the shares, and the further we go down that food chain, the worse it is. I've coined it the buggy whips of the 21st century. People literally think now the junior market is over, just as they did 10 years ago. I think nothing's further from the truth. I think we've had the washout. It would not surprise me that we still may need another few days to get it even a little lower. But the thought of the idea, especially when people with real wealth around the world continuing to put it into the metals, that the junior resource market is over is foolish. So what did I do? I have 2 minutes. I made my challenge again. And people think I'm sarcastic, but I'm not. I'm very serious. I am sick and tired of the media paying heed to bears who are not only continuously wrong, but won't put their money where their mouth is. So I have once again put out an offer. It's a legitimate offer. I have a law firm that already is ready to hold the dollars. I have challenged the first bear to put up $1 million, and I say gold will be $2,000 before $1,000. If it's over prices, they say, it should be a very easy bet for them to accept. And one bear in particular, the worst bear of them all, the absolute worst forecaster that's ever walked on the face of the earth, who happens to work for a gold-led company, I offered to bet him $2 million. And I've even offered to allow his company to put up his money for him, because I doubt very much, based on his track record, he could have any money left. So, I'm on record. I welcome you to come visit me at grandich.com. I understand, and I've heard from people, believe me, I've lost more money in the last 60 to 90 days on juniors than I ever thought I would own in a lifetime. But for anybody who thinks this bull market is over in gold, they're in for a lesson. Shut up, put your money where your mouth is. I'm Peter Grandich. Thank you and God bless.